Okay, everybody, we're going to get started. Thank you so much for joining us tonight for our webinar series. You know, with everything that is going on in the economy, we are getting a lot of questions on, excuse me, really how people can look and assess a deal and understand if it's a good deal. So we thought this was a great time to get our friend Jason Baik here and talk about how to do a deep dive into how we analyze our deals. But before we do, a little housekeeping information. Everything we're going to talk about tonight is informational purposes and just of a general nature. The information shared, conveyed, and elucidated in this presentation is not intended to constitute any legal, tax, accounting, or investment advice. As always, please consult with your financial professional or any independent research before you make any investment choice. So a little bit about your hosts. So my name is Margaret Kozlark. I have personally invested as a GP, an LP, and a fund manager in close to 2,000 doors in Texas, the Carolinas, Florida, and Indiana. I also hold a residential real estate license from Keller Williams, where I work with a lot of investors up here in the Connecticut area. My co-host and partner is Christine Hsu. Christine owns 6 rental properties in Philly and Westchester, New York, and she's also been a GP, an LP, a JV, and a fund manager on multiple syndications across the Sun Belt, over 2,000 units. And together, as Nobly Best, we have 162 million in assets under management, which comprise just over 1,300 units across our portfolio as both general partners and fund managers. So before we get into the content tonight, a couple of things I wanted to mention. One is that, underwriting is a very dense topic, and we could probably talk about this for hours. So our goal is really just to provide a general overview. Everybody's situation is going to be different, but hopefully everybody will walk away with some information that they can use. So to start, we thought it would be helpful to do a quick poll. What is the most important factor in a deal? Is it the market, the deal itself, or the operators? So please take a moment to vote, and then we will move on. Excuse me.
All right, 5, 4, 3, 2, 1.
Okay, great. So let's talk a little bit about, here we go. Let's see. So 50% say it's the operators, 50% say the deal. The market did not get any votes, so we're going to cover that in a little bit and tell you what we think the answer should be. But first, let's talk a little bit about Nobly Best and the things that we look at. So when Christine and I decided to partner together, we really had some shared core principles about how we like to do investments and how we like to serve our investors. First and foremost, capital preservation is key. At a bare minimum, we want to make sure that our investors know that their money, their hard-earned money, is safe and protected. Then, of course, from there, we seek to have returns that are better than what you might get in the stock market, usually through either cash flow or depreciation, which can lead to tax advantages. And we're going to dig into some of these a little bit more in depth as we go along. So let's talk a little bit about what we look for specifically when we analyze a multifamily deal. So it's a big country, right? And there's a lot of properties in the country. So it's always helpful, whether you are looking as an investor or looking potentially to partner with people on a deal, that you have a good feel for what your basic specs are. In our case, we tend to target the Southeast and the Sun Belt region. So these are Carolinas. Again, we like Alabama, Huntsville, Mobile, Atlanta, Georgia. For Texas, we like the Austin, Dallas, Fort Worth area, as well as Houston. Then we've got a few markets in Florida, Tampa, Orlando, and Jacksonville. Jacksonville especially is a high growth market right now. And then there's some emerging markets, Arizona specifically, and in the Midwest, Ohio, Indiana, and Tennessee. So that's what we look for in terms of the market. Then we take a look at the next layer and say, okay, well, let's look at the deal itself. So if you're not familiar with the classification of properties, Class A are the very, very high-end properties. Sometimes these are gated communities, new builds, often brand new, really little to no maintenance at all. The next level is Class B. These are also often very nice properties as well. Maybe not brand new, could be anywhere maybe from 10 to 30 years old, but still in pretty decent shape, maybe needing a little bit of maintenance. Class C are properties that are a little older, right? See, they're getting a little more tired, might need a little bit more work. And then Class D are the properties that definitely need significant repair. Sometimes these are in areas that might have a higher crime rate, that sort of thing. So those are the 4 classifications, and we like to stay in Class B. This is really the heart of the community. This is where you're going to have your teachers, your firemen, sort of the first responder type people. We also like to look for value add opportunities. So what value add is basically when you can come in and you can make improvements and increase the value of the asset. So why is that important? Well, in the last couple of years with COVID, as everybody knows, the housing market was very hot. And that was a situation where the market value, as a result of this buzz, was sort of inflating the values of the property. When we go in and do a value add, we are making improvements. So we are not relying on market appreciation. We are forcing appreciation by improving the actual asset. Other than that, we look for 100 units or more. We do like assets that we can stabilize and get cash flowing, but we don't like properties that are too old. So we tend to really look for properties that are built in the 1980s or later. And lastly, it must have cost segregation so that we can get those depreciation and tax benefits and pass them on to our investor. And speaking of pass it on, I'm going to pass it over to Christine, and she's going to talk a little bit about our deal metrics and returns.
Thank you, Margaret. So for us at Noblevest, we have specific returns that we like to use as a guideline. Certainly with the shifting in the market, there are things that, will shift along with it. So for us, the deals that we look at in terms of return specs, minimum IRR of 15% or more, equity multiple of 1.6 times or higher based on a 3 to 5 year hold. And of course, that number does change according to the hold time. A preferred return of a 6% or higher, and a 6 to 10% cash on cash. And I do want to mention that, a lot of times how deals are underwritten at the start of a deal could make things a little bit gray and arbitrary, because at the end of the day, these are only projections, and that there are shifts in the markets that sometimes cannot be accounted for. But certainly these are things that we do consider at the get-go. And then, Jason will kind of walk us through some of the other, hurdles and metrics that are considered during the underwriting process. For us, we like diversification plays. If you have been in our Noblevest Investor Club, you've seen that we are not just focusing on multifamily, even though that is kind of our core. We're looking at other high yield asset classes. So we've, in the past year, had a portfolio of a fund for short-term rentals. We're also looking at other things like build-to-rent opportunities, potentially self-storage, just other business-related in real estate, things that have more yield. We also like to look at deals that have multiple exit strategies. We don't want to just be limited to one sale. If there's a strategy of refinancing or other things, that is something that we like. Also, especially now in our current climate, we like lower leverage and prefer fixed rate debt or rate caps if it is a bridge debt. And then the debt service coverage ratio, we want to make sure that, that is at least a 1.25, if not higher. Certainly now higher is a little bit better to make sure that the debt is covered. And also we have a segment of investors that we've discovered through our polls that like the higher cash flow or pref equity opportunities. So that's kind of those who would just get a set percentage of return, say for example 9%. They don't necessarily have equity or potential for upside, but they're just stable, set 9% throughout the hold period. And a lot of times these investors will also get bought out of the deal earlier and sooner, so they could be shorter hold time. Okay, so this is our 4-step vetting process. So we do go through a rather extensive vetting process before we decide on a deal and issue it to our investor club. The first thing we focus on is the location in the market. We want to make sure we are investing in a location that has population growth. We like approximately 1% growth annually in the past 10 years. That's not definite, but we want to see a positive trend in the trajectory of population growth. We've seen a boom in the last couple years in the Sunbelt regions, and as the market cools, we want to still see growth in these markets despite people going back into the office. There's a lot of people who have migrated to the South, but they're getting called back if they're working in New York or San Francisco. So we want to make sure that those trends are still staying, and there are some markets that we do see those trends maintaining. Also, job diversity, which results in economic diversity. We don't want to just have, one big industry. So something like a Detroit with the car industry, we want something that has job diversity across many different industries to ensure that people won't have a problem finding jobs and employment, which also helps with, the population growth. And at a neighborhood level, we focus on safety, accessibility, and the class. As Margaret mentioned, we like the class B minus. We may consider sometimes a C plus in a B plus neighborhood for the value add opportunities. Just to make sure that this is the heart of community, that it's a place where people want to raise their families. It's safe and it is accessible. So it might be close to public transportation or easily accessible to major roadways and highways. All right, so that goes with location, desirability, and convenience. And one thing also is considering natural disasters. We want to make sure that all of the considerations are at play. If there's hurricanes, tornadoes, earthquakes, all the likes, that is considered, that we have enough reserve CapEx for whatever could happen. So I know we've had, Margaret can attest to some deals in Dallas having freezes that have resulted in unexpected CapEx expenditures, as well as the increase in insurance costs. So we've seen that recently in Florida, where the insurance costs have more than doubled. So we want to really make sure that we're considering all of that. Our second step is the partners and the track record. So really making sure we're building relationships. Margaret and I attend a lot of conferences and meetups. We want to have FaceTime and really build relationships with our partners, really get to know them, and really make sure that our values align. So everyone has a different why for why they invest in real estate. We want to make sure that their whys match with our whys. And also, what's also very important is their track record. We want to make sure they have a track record and have performance. So what we do in our interviews is we ask them to send us the financials for a property that they currently have, and also their pro formas and projections. And we look at it, against that. We want to make sure that they are delivering what they're projecting. And certainly, yes, sometimes there are unexpected things that do happen, but we also want to understand how they, how they react to it, how they manage it, and how they mitigate the risks. And in addition to that, communication is huge for us. That is probably the single most important thing. We want to make sure that our communication is always consistent to our investors, and also we want to make sure our partners have consistent communication with us. So we ask them how they communicate with their partners as well as their investors, and also we look at their references. So we're talking with one of their LPs or one of their other partners that they've worked with in the past. And also we're doing background checks as well. So with background checks, we use clear checks, and we do that with all of our partners. In our third step, so deal projections. A lot of times this is what we see in the PPMs and investment summaries. We really want to make sure what is shared and what is delivered as projections is truly, you hear the term a lot, conservatively underwritten. And there are certain levers, as Jason will probably mention, that, really show whether or not it is conservatively underwritten. We look at the projections, the pro formas, we're looking at the rent rolls and auditing that, and also what their business plan and understanding the risk associated with the business plan and how they're approaching it. In our fourth step, after Margaret and I have kind of vetted each of these 3 steps, then we send it out to Jason, who is our third-party underwriter, who does another deeper dive into what we are able to do into the numbers, into the deal. And that's really for us to get an unbiased analysis, because maybe Jason may not have the direct relationship. He may not have that bias. And also for him to verify and confirm what we've seen, if that's something that he's seeing on his side as well. So we don't usually come with a lot of information. We're just like, hey, Jason, this is a deal we're looking at. Would you take a look at it? And we really appreciate that he gives us a very objective opinion, not opinion, actually, it's data-based, on all the different metrics and levers. So that's also how we can understand if we have any gaps in how we look at our deals. So with that, I am very excited to present our featured speaker tonight, Jason Baik. He is a managing partner at Compounding Capital Group, so he is actively investing himself. He is also the founder and lead instructor at the Underwriting Laboratory. We'll talk a little bit about that later as well. And then also he's a GP in 350 plus apartment units currently, and is an owner of 7 single family homes. He is a former VP of data science, so he's definitely a numbers guy and loves numbers. He often tells me he likes to just be in the closet looking at numbers. And I really appreciate that. He has an economics degree from Northwestern and is an efficiency nut, as he calls himself, that gamifies everything. That's really cool. All right, so I'm going to turn it over to Jason. And I also want to mention, before Jason takes over, if you have any questions at all on either what was already presented and also what Jason is going to present, please do use the Q&A box. You can type your questions in there. And when we get to the end at Q&A, we will be sure to address them. Oh, sorry about that. All right, I'm going to let you share, Jason.
Okay. Thanks, Christine. Can you see my slides now?
Yep, we see it.
Okay, perfect. Appreciate the intro as well. I think that's the first time I've ever had someone else intro me. I usually, have to read my own script, so very cool. Thanks to everyone for joining us Monday night. Today I'm going to be going over a little bit more about how I help Nobly Vest, specifically Margaret and Christine, go through the deals that they take a look at. Kind of like how she voiced over, I'm supposed to be that third-party unbiased opinion, where I almost never will give a deal an official green light, just because it is the job of the underwriter to point out all of the risks that exist, and no deal is perfect. If there is a so-called perfect deal out there, I'd be very, very skeptical of it. But today I want to go over at least a little bit at a high level, the process that I use to underwrite deals. Hopefully you can learn some stuff, and please feel free to ask questions and I'll try to get to it later on. And so the art and science of analyzing multifamily real estate deals. Before I get into the actual process though, I wanted to get on the same page and at least define underwriting so that we both understand sort of the same language that we're using. There is a bit of a misconception around underwriting where everyone thinks that they can give it to their niece or nephew to just plug numbers into a spreadsheet. My counter argument is usually that you can train a gerbil or a parakeet to plug numbers to an Excel, It's not that difficult. At its core, though, the skill set that a lot of underwriters provide is their ability to analyze risk, mitigate it as much as possible, and try their best to project out what a real world scenario will look like after you take down this specific deal. Another misconception about underwriting is that everyone thinks that you're supposed to open up a spreadsheet first and foremost. And my sort of the way that I teach others how to underwrite is that you should not be doing that as either your first or last step. There is a ton of online research that you can perform beforehand, and also you should be translating those great data findings into plain English. And so if you're ever sending a spreadsheet or opening up a spreadsheet as your first go-to move whenever you get a deal, I ask that you reconsider your process, because I think you are leaving efficiency on the table. There is both an art and science to it. The spreadsheet modeling portion of it is definitely much more of a science, but there are steps that people who aren't heavily technical can do themselves, so that they can get at least a more informed idea or more informed opinion of the deal on their own. And the art portion also leads to some interpretation, kind of like what Christine was mentioning before. Everyone says that they underwrite conservatively, but there is, again, a little bit of subjective nature where it really depends on how your risk tolerance looks in comparison to someone else's. So there's both definitely an art and a science to it. I always say that underwriting is also the best way to get into multifamily and learn the business of multifamily, because at the end of the day, I am the sort of last line of defense before a deal gets taken down. It's my prerogative to make sure that the risks are considered, that the financials are all taken a look at before we go through the effort of going through acquisitions and closing on a deal. So that's sort of what I see underwriting as, the last line of defense. And if you really want to understand the business behind multifamily and not just plugging numbers into a spreadsheet, then I think learning how to underwrite or at least getting familiar with this skill set enough so you can make your own educated, calculated decisions, I think that will take you very, very far. And then in terms of the actual underwriting process, now I'll go over the process, and it's important because, one, if you are active in multifamily, part of what you do on a daily basis is take a look at a few deals every single day, and over weeks and months that compounds into hundreds of deals, if not thousands. Probably not thousands, but you get the point of there's a lot of numbers and deals and details to look at. And so without a process, you find yourself wasting a lot of time spinning your wheels on properties that should not have been looked at in the first place. And so the process that I've created allows me to start at a big picture level, work my way down to the actual nuances of the specific deal that I'm taking a look at. And if it breaks at any point, then I'm able to put the deal on the back burner or give feedback without spending a ton of time plugging numbers into a spreadsheet, and make sure that I'm using the most efficient use of my time as I possibly can. And so underwriting isn't just about the spreadsheet, it is much more about the process. And the process is macro to micro. Part of the reason why you start off with that macro picture is because you need specific criteria that allow you to easily pass on deals if it doesn't meet those criteria. So for example, starting off with the market allows you to ignore all deals that are not within your geographic footprint. Taking down a real estate deal takes a lot of effort, takes networks, takes contractors, takes other partners. And if you're just blindly underwriting deals in, say, Alabama, and you don't really have a network in Alabama, the chances of you being able to successfully take that down is very little anyway. And so as you have core areas that you tend to focus on, you're able to develop more of a competitive advantage, more knowledge, and you're able to just get better at underwriting and taking a look at deals so that you can eventually take down that deal that you're looking for. And so starting from that market, I make sure that, often when I'm taking a look at deals for myself, And for compounding capital, we are hyper focused on the Cincinnati and Ohio region. So if I ever get a deal from Alabama or South Carolina or Florida, I typically pass on it. There are other groups that have multiple core markets. And so even for them, as long as you have at least an idea of the handful of markets that you are targeting, you're able to save a lot of time by ignoring deals from, say, California or Pennsylvania or New York City. Once you have an idea of the market that you look at, similar to what Christine was mentioning earlier, I take a deep dive into the sector or the quadrant or the region of the market. So even if you pick Cincinnati as your target market, not every zip code or neighborhood grouping in Cincinnati is built the same. So I want to make sure that I'm in the areas that I feel most comfortable with based on the business strategy that I'm trying to implement. And then one step deeper into that is looking at the neighborhood, looking at the actual streets. How close am I to specific types of retail? And I'll get a little bit more into the details there later on in the presentation. And how comfortable am I with the neighborhood, the neighbors, the actual asset itself and where it's located. And then once I've determined that the location data or the geographic data is all a green light, then I do what I call rules of thumb. A lot of people might say it's like back of the napkin math, but I try not to use that terminology so that it doesn't, no one should be making a decision to pursue a deal just based on back of the napkin math. I'd rather call them rules that you have to pass in order to get into the full underwriting. And so there's just a few key rules that I've developed based on the hundreds of underwriting sessions that I've done that allow me to know at a high level if a deal will pencil or not. Most of the time, I'll go into a few of the specifics later on, but if a deal is too expensive, if taxes are too low today, if the rent growth is too aggressive, then the deal won't pencil. And you use these to make sure that you're sifting through all of the deals without having to go into an in-depth spreadsheet model every time. And then only when it passes all of the first 4 steps, then do you open a spreadsheet, take the time and effort to plug in, the great numbers from the T12 and the rent roll, and then go down the rabbit hole of doing a full-fledged analysis. And so every time that I do an underwriting session, or I do an underwriting session for a third party, kind of like Noblivest, or there's a few other groups that use me as a third-party resource, I start up from the top and I go down this process to make sure that I'm hitting all of these and that I'm giving sort of that unbiased third-party opinion on whether or not I think the deal is worth the risk that is apparent. Part of the beauty of this process, and this is more sort of like a nerdy thing, or this really only helps me in that the reason why this process is important is that you're able to save a lot of time. A fail-safe, for those of you who might not be engineers, is a term that means that like a machine typically has a fail-safe, and that if one part of the machine breaks down, the entire machine shuts off. So it protects the operator of the machine, and it prevents the machine from, let's say, like blowing up. And so the process that I use to underwrite is similar. Now the stakes aren't as dangerous as someone getting hurt, but the downfall of not using a process is wasting my time plugging numbers into a spreadsheet, going down rabbit holes for deals that clearly didn't work. Even when I first started underwriting, I've had instances where I'd spend 10 hours underwriting a deal. The deal metrics on paper look fantastic. I would Google the address and realize I was in the middle of Camden, and that's not an area that I'm comfortable investing in. So it's sort of like, well, why did I spend all this time when if I had only known where it was to begin with, I would never have wasted those 10 hours. So that's sort of the theory and the philosophy behind why this process exists and why it's so important, especially for people like me who are active underwriters, or even if you're not a full-time underwriter, if you're just constantly looking at deals, it's important to have some sort of system to be a little bit more efficient. And so I talked about how there's both an art and a science to underwriting. And so I'm going to start off with the art portion, which is all of the online research that I go through to make sure that the market, the quadrant, and the neighborhood are in the core areas that I want the deal to be in. And this half, the art half, is the portion of underwriting that I feel like is easily accessible to anyone that is in multifamily. This is the online research portion that, as long as you know how to use Google, almost everyone can do this. And this is the portion that I always recommend, that if you're looking to be a passive investor, a deal finder, whatever, that this is the part you should at least know how to do, because this will at least give you more information, that you're not solely relying on the word of a third party underwriter to sort of make that investment decision for you. So if we're starting off with the big picture, again, we're talking about starting off with the market that you like. And for those of us who, have a few units already, our markets are kind of set. Like I'm in Cincinnati, I'm in Dayton, I'm in Columbus. I'm not really looking to look elsewhere. But similarly with Nobly Invest, they have core markets that they're taking a look at. And so once you select a market, you probably won't stray too far from it. But in the beginning, you have to go through a little bit of effort to understand which areas of the United States make sense for you. And this is a little bit more algorithmic than you probably need to make it. But if you use some of the most common indicators of sort of real estate success, you'll realize that they're all pretty similar. Christine, I think, mentioned a few of them before, but if you look at household income growth, if you look at home value growth, if you look at crime trajectory, if you look at population growth and job growth, those are key indicators that indicate a healthy tenant population, and they are where you want to be. And this is research that's done by much larger syndicators and investors than me. But job growth is almost double the level of importance as other factors. And so if you were to oversimplify this and you were to give every single city in the United States a score of 100, essentially the level of job growth would be kind of 40 points. The 40% of that 100 is just based on job growth. And so if you're looking for core areas to invest in, you want to look for places where jobs are going to, because that usually means that, populations follow, crime rates should go down, household income should go up, and home value should go up. So job growth is sort of that core metric that you should follow. I will caveat that if you're new and you're looking to, start looking at markets across the United States, unfortunately, it's a bit of a weird zero-sum game here, where if you use these metrics to determine the core markets that you want to invest in, everyone ends up in the same exact places, like the Carolinas, Florida, Texas, Phoenix. Like there's no secret town that has explosive job growth that someone doesn't already know about. And so that's just a bit of caution. Obviously, when I take a look at any single deal, I want to make sure that I feel comfortable that the market has enough potential that it doesn't necessarily have to be absolute best. It doesn't have to be Dallas, Texas. It doesn't have to be Raleigh, North Carolina, but that at least a number of these metrics are favorable, because at the end of the day, what's the old saying, where you want the worst house in the best neighborhood. You don't want the best house in the worst neighborhood. Location is one of those things that you can't change. So you have to be very careful with the market you select, and have enough confidence that in the next 5 to 10 years, at least the market will remain stable and won't sort of go down the drain. And then in terms of taking that one step deeper, once you understand the market that you're in, and I need to take a look at the details of which area of that market I want to invest in, the two metrics that I start with are household income and crime. Now, this GeoMap that you on the left side here is a great tool. This is like mapping tool that combines. Actually, let me see if I can just pull it up quickly. It's a tool that allows you to take a look at different tracts of land across the United States, that if you click on random tracts of land, it'll give you a household income breakdown. And it's a great tool to vet the household income that a lot of brokers will show you. A lot of brokers will give you very general household income for a MSA or for a market. And I like to get a little bit more granular, because if I'm in a, if I'm, for example, if this is Louisville, and someone tells me that Louisville's MSA household income is, 100,000, that might look great on paper, but depending on which specific neighborhood you're in Louisville, the range could be anywhere from 20 to 200,000. And so I want to make sure that the property that the address of the property that I'm specifically looking at is in a neighborhood or a section of the city or the MSA that I'm comfortable with. So very simple to use. You can just input any single address, and then if you click on any of these tracts of land, it will give you the household income here, which well, seems very low for this specific tract, but it's a great resource to use, and it gives you a great idea of sort of which regions of a particular MSA are worth taking a look at. And the more frequently that I take a look at the same exact location, I can kind of remember that, like if Cincinnati, for example, because it's my core market, I like to stay on the east side. Anything on the west side, tend to stay away from. In Kentucky, I look to stay to the north of Kentucky. Anything that's more south, that I stay away from. And so you can sort of develop these rules and develop these understanding of your local market as you take a look at more deals and play around with tools like this one, where you can kind of see the household income. And then the second data source that I use when I'm taking a look at just, again, general quadrants is crime levels. Trulia used to have a much better resource, but about 2 years ago they stopped people being able to use the public crime map. And so I don't have one that I actually love today, but Spot Crime is one that I use often. I guess I won't click on this one because it's fairly simple to use. You just plug in an address and it'll give you a visual representation of all the different types of crime that occur in a specific area. And they'll just give you little icons if it's like, assaults or thefts or shootings. And I want to make sure that I'm in an area that has a decent level of household income, especially for the team. If Christina and Margaret tell me that they want to be in a B- area, and I see that the household income of the neighborhood is $20,000, I realize that there's a mismatch, and that's a risk that I point out. Same with crime. If you want to be in a C+ B area and you see that there's shootings on every corner, then that's a good indicator that you're not in the right place. And it's an example of how you can actually just pass on the deal without really having to do much else. Even if the deal metrics looked fantastic after you spend 8 hours plugging numbers in, would you really feel comfortable investing into an area where the tenant base was too poor to afford your rent, or if the crime was so high that you would just be worried for your tenants anyway? Probably not. So this is even going through this, it kind of clarifies how you use this process to make underwriting pretty efficient. And so after you take a look at the specific region of your market, you want to go into the nuances street by street and get a better idea of the types of tenants that might potentially live in that neighborhood. And something that I like to do as a overall commercial investor is that I like to use retail as a proxy to give an idea of the types of tenants that are nearby. Now, as a corporate data scientist, I used to work for a lot of Fortune 500 companies as clients. I have actually colleagues that still work for Spotify and Walmart and Chipotle and all of these big brand retail. And I know how much these Fortune 500 companies spend, how much they spend and invest into their data infrastructure, so that they can cherry pick the right locations for them to open their brick and mortar stores. And so, for example, if I'm in an area that has a Trader Joe's that just opened up, has a Whole Foods next door, if it's got Jared's Diamonds all around, if it's got what are some other bougie stores, if it's got any luxury Gucci or or Mays, you know that there is enough of a tenant base that has disposable income for these big retailers to take the risk in developing a brick and mortar location in that region. And so if you see signs that other companies are making an investment into this specific part of town, then I would feel much more comfortable taking on that risk myself in the terms of an apartment complex. And so the similarities that you share with these retail stores is that you as an apartment owner also offer a product. You have a clean, safe, affordable, modern apartment unit, and you need to make sure that what you are providing is matched up with the types of customers that are around, which are your tenants. And so if you are in an area where other retailers have shown that they're willing to take a chance on tenants that potentially have more disposable income, you as an apartment owner should be able to make that same sort of leap of faith, considering that apartments are a big expense, right? If someone can afford to, buy $6 lattes from Starbucks, or buy jewelry from Jared's Diamonds, or take their kids to Chuck E. Cheese, that's a lot healthier sign that they're able to pay rent on time, versus there are stores such as dollar stores or pawn shops that are designed to be specifically in areas where tenants need cash fast. And you want to stick to the indicators of a healthy tenant base versus avoiding the indicators that tenants may potentially struggle with paying their rent on time. And so I know I kind of voiced them over at a high level, but again, the types of commercial that you want to see, right? The sort of the cream of the crop are the Trader Joe's, Whole Foods, farmers markets, very expensive groceries. Country clubs don't always indicate that the immediate surrounding tenant base is super wealthy, but there should be a wealthy tenant base close enough by. You want to see some niche gyms like trampoline gyms, rock climbing gyms, highly reviewed coffee shops, always a great sign. You want to see kind of in the same vein of gyms, you want to see bar classes or yoga lattes, or Barry's boot camp. And then even high-end restaurants, steak restaurants, sushi restaurants, things that clearly only exist because tenants or residents around the area are able to sort of keep those businesses afloat. At the very least, I want some indication of commercial retail in the need column. So Starbucks, Applebee's, Lazy Boys, Chuck E. Cheese. I want to see Targets and Best Buys and Lowe's. I want to see grocery stores. And then on the last column, again, I want to avoid any indication that the tenant base around this specific property might struggle. So if you see pawn shops, if you see discount furniture or layaway furniture, if you see cash for gold or check cashing places, again, these businesses thrive in areas where residents need cash quickly. And so that's not necessarily a good sign for me as an apartment owner to have an apartment near all of these stores. Similarly, if you only see fast food and it's really hard to see anything that might require a little bit more disposable income, that's something that I also want to avoid. I will say that if you are an apartment investor, most people don't invest in the top of the top luxury class A areas. So you will see some dollar stores or pawn shops nearby, mostly because if you're in a B or C class area, that's unavoidable. And so it's okay to have some of these. You just don't want a lot of these in all cardinal directions around the apartment complex that you're taking a look at. And then along the same lane, going for a virtual drive helps tremendously get a feel for the specific neighborhood that you're in. You want to make sure that you are taking a look at the not only the apartments that are nearby the apartment you're taking a look at. Maybe you want to take a look at some of the other homes, the suburbs that are around the apartment complex, and it'll give you a good sense for the type of community that you're dealing with. And at the end of the day, ideally, it would be great if you knew this area like the back of your hand. If you grew up here, great. If you live here, great. But if you are an investor that's remote, that you've never been to a specific location, and you're trying to determine if this deal is right for you, these are steps that will give you that anecdotal evidence without necessarily having to be there. And Google Maps is sort of the best way to do that. And so if you're in areas that have boarded windows, sidewalks are kind of cracked, doesn't look like the local government takes care of the common areas, then you know that there might be specific problems here. On the other hand, if you see thriving downtowns, if you see a bunch of cars around your property that are more modern, that are in decent shape, it shows that the tenant base might be able to afford the rents that you might be looking for. So you're essentially just trying to do everything that you can to gather evidence that the apartment complex will be able to sustain itself. And the way that it sustains itself is by finding tenants that are able to pay the rents that you're looking to charge. And so all of this kind of falls under that same vein here. I'm going to take a pause because I don't know if people have been asking questions. Oh, nope, I guess it's just yeah, Margaret and Christine responding. I appreciate the added color. And then rules of thumb. So these are sort of the back of the napkin math that I want to make sure that at least pass. And this is based on experience where after reviewing enough deals, I realized that if it doesn't meet most of these rules, that it doesn't matter if it's in a great location. It doesn't matter if I love the neighborhood. It's just not going to pencil as a deal. And so the 6 rules of thumb are more so questions that you have to ask yourself and make sure that the deal that you're looking at passes at least most of these. So are you buying the asset at a price that makes sense for the rent levels? Multifamily doesn't really have this, but single family does, where you have that 1% rule where if you buy a house for, let's say, $100,000, you need to charge about $1,000 to make it worthwhile. So multifamily is similar in that sense, where obviously you're buying this asset for a specific amount of money and you have expenses associated with it. And so if you buy something for $100,000 a door in multifamily, you need to be able to charge, let's say, I'm sort of fudging numbers right now, but you have to be able to charge $1,300 a month in rent to be able to offset all the expenses that you have to pay. And so this is a good rule of thumb where if you see that a seller is asking for, $250,000 per door, and you're in an area that you know that you can't charge anything more than $1,200 in rent for the units available, there's just no way you're going to make that work. And if I see a deal like that, I can easily pass without having to go through the effort of plugging in an entire spreadsheet model. The second point here, does household income support the rent projections? Most property management companies use a 3x or a 4x multiple to make sure that the tenants that are around the area can support the rent that you're asking for. You want to make sure if the deal is too expensive, kind of like the example that I used before, we're past a certain number, let's say $150,000 per door, it just really doesn't make sense to try and take it down unless you're dealing with an experienced operator. But if you're trying to take it down yourself, it probably doesn't really make much sense. You have to know if taxes are going to get reassessed, what the current expense ratios are, and that gets a little bit more into the nuances of the science of underwriting. But making sure you're able to answer these questions makes it very clear on whether or not you have to go through that effort to begin with. And then the last sign, I've kind of been mentioning it for a few minutes now, where I always look for science of commercial development. I do not like investing in rural areas. And so that is a rule that I use. But if I'm underwriting for another team, or if you're underwriting for yourself and you're okay with rural areas, you can kind of, change that to something else. But the rules are developed with experience, and that allow me to make sure that I am confident that this deal has a high probability of penciling out before I start plugging numbers into a spreadsheet here. And so putting it all together, the beauty of this process is that, again, I get to start from the top, make my way down step by step, and any time it breaks, I'm able to pass on the deal and save that time that I would have spent if I didn't have this process. And so again, part of this is my level of efficiency, as Christine kind of introduced me with. I am an efficiency nut. And so the purpose of a process is to make sure that you're not wasting time that you could be using towards other parts of the business. And so that's how the fail-safe mechanism kind of comes to life in underwriting. And today I can probably pass on more than half my deals without looking at a spreadsheet by following this process. And again, just makes my life a lot easier. If you are using an underwriter to take a look at a deal for you, I'm sure they should have a similar process to this. Now, you might still want them to go down the rabbit hole of fully fleshing out a deal that you send them, but still there has to be some sort of method to the madness to make sure that they are taking a look at the market, the neighborhood, the household income, so that they can give you at least a comprehensive overview of the deal that you're taking a look at. And then the second half of the process that I follow is what I call the science, which is more of the spreadsheet modeling. This is the portion where I really can't go too much into depth just because it's very, very heavy, but I'll just voice over just in a few minutes kind of what all this entails. So you need the T12, the rent roll, tax bill, potentially offering memorandum, and you essentially take all of that great information, put it into a model to try and see if there is a chance that this deal could work out for general partners and also for limited partners. In terms of the different aspects of the model that you're taking a look at, you have sort of this high level understanding of the property needs to generate enough income and reduce the expenses enough where the amount of money that the apartment complex generates is worthwhile, both to give to general partners and also obviously to limited partners. And so at the end of the day, an apartment complex functions very similarly to any business out there. You want income to be as high as possible. You want expenses to be as low as possible. And sort of the operations of getting income high, expenses low is sort of the business of multifamily. These are some more of the nuances of what income is comprised of. Same with expenses. I won't go too much into that, but part of an underwriter's job is to understand the different types of levers and inputs that go into the model. And I can't go over all of these in detail, but debt, obviously, capital expenditures, taxes, insurance, fees, investor returns. Those are the different portions of the actual spreadsheet model that a lot of underwriters will have to get feedback from, whether it's talking with a property management company, whether it's talking with a contractor, whether it's talking with partners. You have to make the assumptions that will try to project out what this business plan looks like, and you're trying to make that projection as accurate as possible. And part of what I like to warn people against, though, is when you're taking a look at deals, it is very easy for anyone on paper to make a deal look amazing. And I say that there's about a dozen levers that you can push and pull that allow essentially every deal in the world to pencil on paper. And part of what I like to do is that I like to give people an understanding of the levers that I am pulling. And especially if I get a underwriting model from someone else, I like to tear that apart to understand what levers they're using. And these levers are the definition of your risk tolerance. So part of what I always promote is that everyone should at least understand what these levers are, how they impact the returns, and understand how the underwriter might be pushing and pulling some of these levers so that you know that you are on the same page as the underwriter. So when I do work for NoblyVest, we make sure to get on a quick call or at least discuss all the levers that are being manipulated so that they understand the level of risk that they are taking on. At the end of the day, it's really difficult to give a overarching rule of thumb on, GP or LP split should be exactly this, or taxes should be exactly this, because it really depends on your specific risk tolerance and what you are willing to take on. But most of the success in real estate that you'll find, in my opinion, is based on that education and knowing at least just enough to be dangerous and to keep yourself safe at the end of the day. And so these levers are pretty self-explanatory. There's nothing here that should be groundbreaking. These are all inputs that you input into most spreadsheet models. And so by changing the refi year, by changing how high your taxes went up, by reducing the CapEx budget a little bit and assuming that you can, finish CapEx a little faster, all of that has a drastic impact on the returns that are projected. And at the end of the day, obviously, underwriting is just a projection. It takes a lot of time and effort for you to actually implement the process afterwards. But again, I always recommend people to at least be aware of what's going on so that they know what they're getting themselves into. I know I've been talking for a while. I think that's all that I had for this underwriting. I could go through some of a case study that I have, but I don't know. I know we're a little behind on time, Margaret and Christine.
I'm thinking since it's close to 8, maybe we should just do a little Q&A, just because I believe we have people allotted for an hour, unless people would like to stay and have more. We can ask, what people would like.
I feel like there's so much great content that we have enough for a part 2.
I know that maybe that's what we do, Jason, that we come back.
Yeah,
and do part 2.
happy to do a case study. Yeah.
Yeah, that'd be great. Let's go ahead and move forward towards Q&A. And maybe we can wrap in about 5 minutes or so. So if you have any questions, please feel free to put it in the Q&A box. I actually have a question about those levers, 12 levers, which were really helpful for it to be spelled out like that. What are some common levers that you see often underestimated?
That's a good question. I don't know if there's one that's underestimated, but the one that's easiest to hide is actually rent growth. A lot of people lump up rent growth into this one large number, and sometimes it makes sense, sometimes it doesn't. But yeah, the rent growth should be actually itemized a little bit more carefully, because there's a difference between how much rents can go up because the market is super strong and the market kind of just carries rent growth versus the amount of value that you're injecting into the deal yourself with operational efficiency or transforming the community or doing a lot of CapEx budgets. And so that's actually one that I always look out for, because the last thing you want a investor to tell you is that they're just super bullish on a market, and so they know they're gonna get 10% rent growth. That's always a big flag, because if you put 10% rent growth on any deal, it just looks fantastic.
Mm-hmm. Yeah, absolutely. We've got one question in from Sandeep. Jason, in commercial real estate, cap rates play a critical part. Was this mentioned in your presentation?
I did not mention cap rates, and cap rates. It's funny because I usually have a slide here where I say that cap rates actually don't matter at all. Cap rates are a industry term that's used for people to agree on how competitive a market is. And it's important to estimate what you think the cap rate will be in, X number of years when you try to sell. But especially if you are a value-add investor, which I think most people will be, like most people don't buy Class A assets and are just looking to hold on to it forever. So if you are looking at a value-add deal, the cap rate that you buy it at is it's a moot point, because you're looking to inject value into it anyway. The goal is that you're going to buy it at a terrible cap rate and drastically increase it or make it better in your favor, because that's the point of value add. And so too many people focus on cap rates. It's something that doesn't really, the more you understand a spreadsheet model in any underwriting scenario, the more you realize that there's like literally one cell that you put cap rate into, and like other than that, it doesn't really have an impact on anything. So for you as a buyer, it doesn't really make a difference. For you as a seller, yeah, it'll make a difference in 5 years, but you just try to project conservatively, and you can't really control that.
Yeah, and it's really
Jason, I have
interesting.
oh,
Oh,
sorry. Go
sorry.
ahead.
It's really interesting how drastically cap rates are changing. We've seen them compress significantly in the last 2 years. Now they're just all over the place. It's really hard to even say what cap rates are right now because we're in a transitionary time.
Exactly.
So Jason, this might be difficult one for you to answer, but we got a question. What are the right return metrics to aim for?
Yeah, that's a great question. It's one that I, get all the time. And the last slide that I had that I kind of went quickly over, it just said the risk adjusted returns. Those are like the three magic words in multifamily real estate, where it really just depends on the level of risk that you're taking on. If you are working with an experienced investing team that, is taking down a B class asset in an amazing area, you should be willing to take on lower returns. On the other end, if you're getting those same returns, if you're getting, 15% IRR and you're in Camden, New Jersey, then I highly suggest that you reconsider what you're looking into. And so I think the returns that you showed are very reasonable. They're very, like benchmarks, like they're great benchmarks to aim for. And then if you start with that as your starting point based on, a solid operating team, solid area, solid asset. If you're looking for higher returns, you have to take on some more risk. And if you only want, beautiful luxury 2022 built assets, then you should expect lower returns.
And then the only other one I see is that earlier we asked, what is the most important factor in a deal? And we gave the options of the market, the deal, or the operator. So people want to know, what is it, Jason?
I guess that could be a little bit of an opinion point, but I think that it's the operating team, because even if a deal is fantastic, most people bet on the jockey and not the horse. And so you can have an amazing deal that pencils great, that looks fantastic today, but the truth of the matter is for the next 5 to 10 years, you're going to have individuals that, go through a ton of obstacles and have to figure out how to deal with the pain and suffering of owning a multifamily asset. And so even if it looks fantastic today, if you don't have the right team in place to overcome the inevitable obstacles, and like I guarantee you, there's never a deal where everything that you underwrite perfectly comes to fruition. Like there's always going to be something that happens. And so if you don't have that right team in place to kind of stay nimble and stay on top of things, then I argue that the deal is going to fail anyway.
Yeah, we like to give the analogy of flying a plane a lot. So you can have the most beautiful, top of the line, the latest model of an airplane, but if you have inexperienced pilots and you're in a storm, they're going to crash that plane. Doesn't matter how beautiful that plane is. So, it's all about the pilots. They have to know how to weather the storm and have the experience, the track record. We put a lot of emphasis on vetting our partners, and that is, that's the reason. So we got one more question before we close out. Thanks, Josh, for asking. Outside of the 12 base levers, are there any others that can have significant impact?
That's a great question. I specifically picked 12 levers, not because it sounded nice because it was a dozen, but because those were the biggest variables that impacted the return. So, there's obviously a lot more inputs that go into it. You can do like, maybe unit mix or insurance costs, but they are much smaller than the 12 that I showed. And so if you're really trying to understand sort of how most people make deals work, I would focus on the 12 because they have the largest impact.
Awesome. Thank you so much, Jason. We have, oops, sorry. This is
Lost that slide. While Christine's getting the slide up, we do want to mention that Jason has an underwriting course. Do you want to speak about that a little bit, Jason?
Yeah, sure. Part of what I do is I teach others to underwrite based on my data science background. I don't want to say a unique point of view on underwriting, but I know the difficulties of trying to learn all of these this number language and all the complexities of using spreadsheets. So I try to simplify as much as possible. And I love to meet other people that are technical, that are looking to develop a career using underwriting as sort of the entry point. So feel free to reach out.
And I think the most important thing you said, Jason, was that you can eliminate 50% of the deals before you even open up your spreadsheet. So.
Yeah, exactly. That's the process that took me a long time to create for myself. And I love sharing it in the hopes that, it saves you some of the headache that I went through.
Thank you so much, Jason. You have his contact information there. If you have any questions or if you want to talk for hours about underwriting and numbers, please feel free to reach out to him. Also, for our limited partners, this might be a lot of information, and you don't need to know all the ins and outs of analyzing deals. That's what we do for you. But if we feel like it is your responsibility to vet your deals as a limited partner, we are providing key questions to ask before investing in a syndication deal. It's in the chat box. It's basically a spreadsheet with different questions that you can ask from a deal level, market level, and in partners level, operators. These are just great questions to keep in the back of your mind as you're looking at investment summaries, reviewing deals, and really understanding and assessing if it's a right deal for you. So yeah. And with that, do we have anything else to add, Margaret or Jason?
No, just so glad everybody came out to hear about this, especially, last couple of years. If you didn't make money in real estate, you must have been really trying not to. But as the economy is shifting a little, it's really important that, we look at deals very carefully. That's why, we are really making sure that we are vetting everything very carefully. And this was a really important conversation, Jason. So thank you for joining us.
Yes.
Thank you for having us, or thank you for having me.
All right. Thank you so much. Have a great evening, everyone.
Good night, everybody. Thanks for joining us.